Everyone, and back to the Peterson Institute for International Economics in one of our first banner events of the new year. A happy new year to everyone. I'm Adam Posen, president of the Institute. As many of you are seeing, even places of safety can be causes of turmoil these days. And even turmoil is not necessarily all that it's cracked up to be. I think we are looking at a normalizing world with a tendency to overreact, but it's entirely possible, just as in 2008, we're much too sanguine. Essentially, everything is up for play. And so that makes it especially fortuitous today to have with us as our speaker Min Ju, the Deputy Managing Director at the IMF. Min is going to be talking today about unlocking global growth, a wonderful title, and we know that he will sort through the structural from the cyclical, the possible from the feasible, and the attainable will be what we're left with, and then we hope everyone will do what he says. Obviously, our friends online, our friends here today are well aware, but Min Ju has been Deputy Managing Director at the IMF since July of 2011. Previously, he was a special advisor to the MD from May 2010. He's, of course, a native of China, a former deputy governor of the People's Bank there, where he'd been responsible for international affairs, policy research, and credit information. He had been in the Bank of China separately from that, and, of course, getting important private sector experience, in fact, as group executive vice president. He's taught economics at Johns Hopkins and at Fudan, and worked at the World Bank. He, of course, has a PhD in economics from Johns Hopkins, like many of our colleagues. In short, he is among that stellar group of technocrats with broad experience, global vision, great wisdom, and a little bit of a sense of humor. So with that in mind, I'm delighted to welcome my friend Min Ju to the stage here. Thank you.
Well, thank you very much, Adam, for hosting this event, and thank you for your very kind words. For your introduction, I'm like you call me a little bit of tech crass. I'm just a little tiny, small tech crass. A little bit of humor, obviously, no comparison with yours. So, of course, a little. I'm very happy to hear that. Oh, good. The screen is on already. I'm going to talk about today is very much unlocking global growth. So much has been talk about the growth, which is a very common issue. So I'm thinking about what can I contribute to this talk. So I try to decompose those issues, the growth issues, from trend to the structure issues, and also try to decompose, separate the real economy from financial sector as well, and see how things goes. So I will talk about cyclical recovery, which is slow. But meanwhile, we see the divergence between the real and the financial sector. And the macro policy space is quite limited. On the global structure challenges also emerges. So then come to the policy response, what can we do, what should we do, and to move the whole issues forward to lift the potential global growth. So this is the outline. I will talk roughly, Adam, with your permission, 25 to 30 minutes. Is okay? Yeah. As the food is wonderful, so eat slowly and particularly enjoy the dessert. And so it will give me a little bit more time. And otherwise, when you finish eating, Adam will push me off. The first is the cyclical recovery. This is the trend, the global GDP. We re-indexed to 100 in 2000. You will see the red line is very much the forecast we, the red line is the projection. This is the projection. And in the 2007, actually it's a wrong indication. But this is the real things here. So what we did is really we're below the trend, so quite a big gap. We lost this portion of the GDP on the permanent base, which lowered the potential growth. which is quite a big shock. This is very different from whatever we had the previous experience. Before, they always rebound, go back to trend, and go back again, and then move forward with the trend, which is the experience we had before. So if looking for the growth, very much, we're looking for up to the 2019s, you will see we still have a relatively moderate and growth for the whole world, but we don't see strong rebound. And for the emerging economies, they are very much in a maturing cyclical position. So it's really, they are gradually adjust and gradually losing their potential growth rates and in adjust process. Now, why is that? It's very interesting. You will see. Do I have a laser here? Oops. I touched the wrong button. I need your help. Oh, come back magically. Okay, that's good. Okay, I guess that's no laser anyway.
I don't think we're insured for lasers. So
Yeah. So what you see here is very interesting. The first issue, this is the worldwide investment. Even with very strong investments in emerging markets, the total investment in share of GDP is lower, which is absolutely amazing. Although slight, but still lower. The total consumption is a little higher with the 2000, but with the year 2000, it's also lower. But really push the growth of the whole thing is the government expenditure, which is roughly 2% high than 2007. 2% is a pretty big number in terms of government expenditure, in terms of support of global growth. And the investments weak is really an issue here. That means investments growth is even weaker or slower than GDP growth. And the GDP growth is not terribly strong at all. Now, further, but it's not only it's investment. If you're looking for the global FDI, you will find it's also very interesting. It's lower. It's roughly dropped today than roughly 2007. It's a 40% drop from 4.2, 4.3% of global GDP dropped to 2.7, which is quite a big drop compared with roughly 14 years ago. It's a roughly 40% drop. So this is a question why the cross-border FDI drops so much. And also this happens on trade. You see the trade growth is always stronger than the GDP growth, particularly in 1999, and continue until 2000. But in the past 6-7 years, the trade growth is even weak, lower than global GDP growth, which is very big fact for this moderate growth as well. And we'll come back to see why and how. And the one big reason, obviously, is the deleveraging. So let me spend a little bit of time on the deleveraging, the charts we did. This is the minimum level, the historical minimum level. This is the maximum level since 2008. This is the deleveraging in the government sector. And this is the current position. So you will see in the stressed European countries, you will see they're still at the high level in terms of interest expense. They still pay very high. And in other European countries, they gradually go back to the minimum level. US is here doing quite well and on that level. But if you're looking for the 5 years sovereign credit default swap spreads, you will see the same thing happening in European countries, particularly Southern. The spread still is way, way high, and in the other countries getting better. So this shows the deleveraging process. This is very much the market index for the deleverage on the government side. And if you're looking for the household side, you will see household deleveraging proceed, but it's still pretty way high. This is in the stressed European countries. You will see many household debts in terms of the leverage issue still way to the peak. And gradually some countries coming down. And if you see the US here as a household, the deleveraging goes quite well from the peak drop to not in the minimum yet, but quite close. And the UK is here, Japan is here. And you will see household debt service burdens. And if you're looking for this whole issues, you will see more or less the same patterns in some stressed European countries. It's still way high. Some are just going down. So it's still in the process in the house sectors. If you're looking for the corporate sector, you will see the things, they adjust a little bit of in same story in the stressed European countries. The corporate sector didn't adjust very much. It's still on the peak, and gradually one here. But even corporate sector in the US, in the UK, and also in the US is here, still at the more or less the high level, not adjust to the minimum level yet, which is a little bit of surprise from sort of a sense. We saw the corporate sector responses quite well. But in fact, if you're looking for carefully for their balances and looking for the interest payments are still pretty way high in the corporate sector balances. And really, in the banking sector, the balances adjust is doing very well. The leverage ratio drop. It's quite good to go back to minimum levels. But meanwhile, the profitability actually become very lower. So in that sense, the banking balance sees a strength. The banking profitability actually is weaker than before, which in a certain way restrict the banking lending capacity. I think this is very important. So deleveraging is still in the process. Deleveraging is not an easy process. Here's the Japanese cases. If you're looking for the Japan case, you will see when the corporate deleveraging in the process in 1980, 89 dropped down, how do we maintain growth? It's a government spent money. The government debts increase to support aggregate demand. So you will see GDP drops, the manage more or less like a 2%, more or less back and forth, but maintain a certain degree of growth, which is very important. But you see, this is the corporate deleveraging, the deleveraging government leveraging process goes through. Now we have another interesting case. It's the UK. If you see the UK case right after the World War I, you will see the government is really increased and dramatically. And when the government increase, what do you have to do? What you have to do is you have to maintain the primary budget balance on the positive because you have to pay. You have to pay the interest rates. When you have a primary budget, maintain the positive things, what do you do? You cut the expenditures. You see the growth drops dramatically and gradually recover. You see two very interesting cases, two extreme poles actually, and show the very different country experiences, show very different policy reaction to the deleveraging process. We today are between. But not in Japanese case, because not many countries have the huge capacity to leveraging government balances. But countries are not in the UK case either, because it's not easy to take the UK policies, then you have such a big, sharp GDP drop. And so deleveraging is not an easy process. I think we probably should not underestimate its process and the impact on the growth as well. Now, then move to the credit investment side. You will see in the US side, although still relatively below the trend, but the credit investments moving quite well, and Japan actually moved quite well, although it's a low level. But if you're looking for the euro, even in the emerging market, you will see really the investment the credit supply is also way low, way low. I think this is quite a big, and the credit supply has a big bag for the investments. So this also means banking sector are not strong enough to provide the credit for the investments, which is another reason to see why it's weak. Even in the US case, US had a strong growth. Last year, we expect to see even stronger growth for this year. It's good news. But if you're looking for the whole decomposed numbers, it was very interesting. House savings increase, which is good. Non-financial corporate sector saving is really increased now. It's more than 3.5% of GDP. And the government saving, obviously, is negative. It's roughly 6.5%. That's the case. But what you see here is a household investment drop. It's quite a big, and the corporate, it's a non-financial sector. Corporate investments also drop further compared with year 2000s. And the government investments all drop. This is the financial sector investments. So you see the saving and the investments relationships also go into very interesting directions. The saving picked up. I mean, you have to deleveraging, you have to build your saving base, but investments really drop further, which is a one one very important reason. And because investment is very slow and the growth is weak, so inflation expectation is very not only lower. This is 5-year forward inflation swap. You will see it's not only lower, but it's on the downside. This is just a few days ago. The market raised. You will see inflation expectation still on the downside. So if we bring whole thing together, you will see after 8 years, I mean, this financial crisis, we still see a relatively moderate or low investments, low inflation environments, and moderate growth. And it's still we're more or less in the deleveraging process. The process is not finished yet. We still sort of try to get out this trend and fix away the trend. I think that's the first issue. Now, when real economy grow in a moderate way, the financial sector rebound strongly, which is quite interesting. If you see here, the financial sector assets, the global assets, roughly from 80 trillion to 170 trillion. This is understandable, but even after crisis, it's continued to reach 200 trillion now. In emerging market, roughly 14 to roughly less than 50, 40, and to roughly 70 trillion. The financial sector grow much more stronger than the real economy, and the financial sector obviously will see take more risk because this is sovereign spreads. This is a Z-score, so that's the deviation from historical expectation or distributions. You see, the Z-score is below the zero, so market is overvalued. You see the corporate spreads, Z-score is also under the zero, is also overvalued. And the volatility is extremely weak. So financial growth, sector grows strongly, and the risk appetite actually increase in quite a big way. And more than that, in financial sector, really is moving into the non-banking sector. Shadow banking sector grows strongly. As we always talk, this is a big issue for 2008 financial crisis. You will see the asset management sector today is grows strongly, and bigger than insurance, bigger than bank. And ownership for corporate and the foreign bonds, you will see once again, this is the asset management companies really play more and more important role. I mean, what happened today, for example, in advanced economy in these countries, the banking lending compared with 2008 accumulatively is negative to the corporate credit. But non-banking issue more than $1 trillion credit. So it's the shadow banking play more important intermediation today now. So it's a move to the shadow banking. Shadow banking obviously play his role, but we've got to be very careful what will be the risk associated with the shadow banking the expansion as well. So we will see a shadow banking expansion, the concentration also very big increase. You will see this asset management company in terms of high yield bonds, in terms of emerging markets, and external debts, they're holding shares quite a bit. You know, it's around 35%. So you will see this is very high, and 10 big large asset management companies share also concentrations is also big, and the liquidity mismatches become a big issue. You will see the number of days of the full liquidation of the U.S. credits and mutual funds, the ETF, is really pretty high today, which is once again, it shows the market liquidity issues very much from the central bank liquidity issues. There's a market liquidity illusion issue there, which is an issue. And this is another concentration for the fund. It's a Franco Templeton funds. You will see in Uruguay, they hold roughly 14% the whole total to the best, Hungary 13%. And this is a few big funds holding quite high shares for this country's sovereign and the corporate bonds as well. So the concentration risk and become quite big. And when central bank expand the balance sheets, everybody thinks liquidity is ample. You will see the market also, once again, go back to the previous year, the size of a trader becomes smaller. It's really from 13 trillion into roughly 11. This shows the liquidity issues. And also you see the duration of the portfolio increase, obviously, because the low interest rates also is indicated liquidity. And the market need to be clear the pie of the bonds, and the dealers' inventory is become a bigger and bigger gap now. which also show the structural liquidity issue in the financial market as well. And this is not only advanced economy, but also will have a global impact. If you're looking for the whole thing, you will see advanced economy bonds allocated to the emerging market today very much rich to 9 to 10%, which is very much the model defined, which is very high if you think about it as roughly 3.5% before the crisis. And you will see the market movements, actually, synchronization, the movements in the assets price is moving extremely high today. And you will see if the US have a shock or have interest rate change, the impact on the emerging market with various Turkey, Indonesia, and Brazil, you will see the total shocking, this simulation can be quite high, range from roughly 200 basis points to 500 basis points as well. So it is a global impact. So adding them together, you will see it's very interesting when the real sector grow in a moderate way, the financial sector rebounds strongly. When financial sector rebounds strongly, it's really moving away from banking sector to the non-banking sector. When you move into the non-banking sector, there is a concentrate issues, there's a liquidity issues, there clearly is a market liquidity structures, market liquidity illusions, which had the potential risk for financial sector as well. Now, then the third issue is that the market policy space is very limited after 7 years and it's a financial crisis. This is the public debt. You will see, this is for the advanced economy and for the emerging market. It's the most advanced economy. In average, debts really increased from 70 to the 110, 115 now. Japan, obviously, the highest one, and Italy, you will see those. It's quite, in average, more than 90%. This is Ken Rogoff's new line for the debt sort of guideline, which is 60%. So I think in advanced economy, even in some emerging markets, more than 60% now, which is way higher than 40% sort of guideline for the emerging government debt ratio. So that's increase. And if you're looking forward, even for end of its decades and 2019, in the total advanced economy, the public debt is really increased roughly before the crisis, 73, 74, jumped to the 107, and gradually, slowly coming down. Hopefully, they're coming down to 110. It's really pushed the space for fiscal area with that high. Emerging market, we did 2 forecasting for the emerging market fiscal consolidation. This is 2012, so we hope that the balance is getting down. But the real situation is that government deficits are much lower, bigger than we forecasted before. And debt to GDP ratio, so increase. Although it's relatively low at the 40%, but with 40% threshold, and the debt is on the upside, the forecasting is should go consolidation with downsides. So in both emerging and advanced economy, fiscal space is very limited. Why is that? In deleveraging process, before what we see, you want to reduce the debt, you need 3 key issues. You need the debt growth, nominal debt growth, be smaller, as small as you can, but you need inflation, and you need growth. So it's a 3 key factors that try to bring the debt down. This is the Asian financial crisis, a very strong growth and moderate, relatively also strong inflation, and the debt increase moderated, so they can get rid of the debt quickly. And it's not, this is time for the global financial crisis. You will say is weak, inflation is weak, and although debt increase is still relatively small, and this is for the advanced economy, this is for emerging market. You will see in emerging market, inflation actually play quite a big role in terms of reduce the debt as well. Now, what happened today? Well, the very interesting chart compare this crisis with all the previous crises. What we found is this is a cyclical adjusted primary balance. So we adjust the cyclical fact, and it's a primary. So it's not the headline budget. If you're looking for that, you see in this time, even adjusted primary balance is negative. That's a pretty serious issue. That means you continue to borrow money to pay your interest rates. So that's the reason it's clearly, this is a previous crisis, it's a current crisis. When the debts go up and go down, we continue to go up. And the two key factors that contribute to debts down, the growth is much weaker than any crisis before, and inflation rate is much lower. That bring the fiscal deficit low extremely challenging. Well, the historical data, we did roughly from 1875 to today, roughly for 77 fiscal crises we had historically in the world. What we found is, if the debt's over 100%, it will be very difficult to bring this debt down. You either have a hard landing crisis, and we don't have very much case. This is the grace here. It's very from 1888. I have another grace. It's 1983. We have a grace here. And it's very difficult to bring them down. In all these cases, what we found is really the United States did a good job in 1948, Canada did a good job in 1995, and Italy in 1992 will be able to bring them down. Italy is still around 100. Otherwise, we have Belgium, UK, we have Japan. When you're over 100, because you need strong growth, you need inflation, you need the really control the debt growth. It's very difficult to bring them down. So it's a physical space is a big issue. That means we don't have very much the stimulus space for further growth support. This is really the table, put the cap on the debts. I hope the people in the back can read, because I on purpose put number in. The number here said, let me read through. In 2007, all the advanced economy have the debt to GDP ratio, government debt is 72.7, and in 2013 is 106.5. So the debts increased more than 40%. What are the interest payments? 2.9. Doesn't change at all. Doesn't change at all. If you're looking for Japan, from 183 to 243 debts, the interest payments increase only a little from 1.9 to 2.0. And in the emerging market, the debts increase, for example, total 37 to 42.2. The interest payment dropped from 2.4 to 1.9 because they get a better rating. The market gives them a good rate. What does that mean? If interest rates increase, 100 basis point interest rates increase will make this physical space extreme challenge. We'll be able to manage it for advanced economy, the debt ratio more than 100% is still manageable because interest rates very low. So the government's fiscal burden to pay the interest rates is still. So then the moderate growth and the low inflation rates still be able to, in the sense, manageable. If interest rates change, it will change the whole fiscal space. In the monetary space, you will see also things happen. Obviously, this is central bank, the balance is expanding. It's not only the advanced economy. This is China for emerging market. This is for Russia and for India as well. The global central banking sector is expanding their balance sheets. Interest is way low. Everybody knows that. We expect to see the interest increase. But the long-term rate is really still on downside. The market read very differently. When we have a QE, we have a non-conventional the monetary policy up to this point. It's a very interesting phenomenon. You will see a few new issues pump out. The first issue is really the long-term rate is really low. This is the German rate. This is the real. This is the real yield. This is the nominal, and this is break-even yield. You will see it really low. On the compare, we put them together. And with the different monetary policy, we're going to see in the next 12 months to 24 months, and you see as the exchange rate changes, the currency market changes. So when we say in the monetary policy, we don't have very much space because the big balance sheets and rewarded balance sheets is an extremely challenging task for the central bank. And the low interest to raise interest rates, so also think about if you raise interest rates, what happens on the long-term interest rates? What do we see once again the same things like 10 years ago? At that time, short-term, long-term interest rates not aligned together. What would that be the impact on the market? When the U.S. central bank and the Europe and Japan have a different monetary policy, one is tightly on the way, one is still continuous easing, and the markets will respond to a very different way. Because once again, since this year, because of this different policy, the central bank's injection into the liquidity to the market will be very different from any year before, because the Fed is still the major central bank in the world. When Fed try to slow down, and ECB and Japan come up, so total aggregate liquidity size will be very different. And the structure change, because the liquidity structure from ECB and Japan jointly and move against the Fed, what is liquidity move? Where do they go? It really another issue for the market. So we'll be able to see on those liquidity structure change, and obviously will reflect in the currency market with the dynamics of the exchange rates. So in the monetary the space, we don't have very much space because the zero interest bonds on the big balance sheets, but also with the different divergence monetary policies, with the strong dollar move on the liquidity structure change, the liquidity size change, and the currency market volatility, it will be new issues for these years as well. Now, there are global structure changes emerges when we see those trends issues as well. And the first issues is shifting global growth gravities and from advanced economy to the emerging market. Everybody see that. I mean, once again, you will see the growth at total GDP with the PPP measure, the emerging market today is really big now. And also in the investments, you will see the emerging market investments really over the advanced economy become the main player. And in the consumption PPP is still relatively small, and exports more or less match advanced economy. And FDI still small, but really catch up the whole thing. And FDI liability, this is FDI the assets. FDI liability, you will see emerging market income more and more to pair to each other now. By PPP today, emerging market is bigger than the whole low-income country is bigger than advanced economy. It's a big shift. Now the question is whether emerging market will continue to grow. We see the emerging market have a maturing cycle positions. The growth is slowed down. We'll see that. I think that's everybody see that in the world. We'll see the continued lending and with losing the potential growth in a moderate way. And but given the adjusted process they had in the past, we did a study. We tried to see this is the vertical is the growth. This is a horizontal. I call it catch-up index, which is the per capita emerging market GDP relative to U.S. per capita GDP. So that's the catch-up because the whole end of you want to get the U.S. level. So you will see the path of development is not easy, right? If 60 to 66, you will see they grow strongly, the convergence. But then 70 crosses, 80 crosses, they go back and forth, and no convergence, the growth to drop to zero, drop back. And as disconvergence and divergence go back, and it was in the end of the centuries with a very good external environment, good macro policy, they start to maintain strong growth and convergence. Today, emerging market total is still roughly 27% for American per capita GDP. This is the process. So we will see the emerging market will have a bumping road to move forward. But given it's 27% of American GDP, we see huge space for emerging market to catch up. The world is changing. Because emerging market drive the growth, drive the investments, drive consumption, drive FDI, and drive trade. But that's the part of the story. But when emerging market become bigger and bigger, who are losing their market share. So you will see US economy is still on downside, but relatively on the slow path, but really the Europe and the Japan lose their market share in a quite a big way. So you will see it is not the size issue, it's a global competitiveness shifting around the world. That will lead to change in the futures. If that's the case, with further few things, everybody have to redefine their production function as well. Now here's another interesting table as well. I use the table because I want to show the number. With this relationship in mind, where the emerging market take up, we see very interesting change globally. In 1990, in the advanced economy, they have a consumption roughly account of GDP at 75.1%. And gradually increased to 2010, before the crisis, 78, continue increase to 80.1, gradually a little bit reduced last year. Now this is Econ 101, right? The GDP equivalent to C plus I plus X minus M plus G, okay? Now, if they invest, consumption increase in big share, what do? They have to reduce the investments. So investments from 24.9 in 1990 drop all the way down to 2010, 19.9, a little bit back in 20.3. Now that's easy, right? Everything have to add up. So you increase consumption, you reduce investment. Clear. But that's not the whole story. The really interesting happen is other side of the world. When advanced economy increase their consumption share, reduce the investment, who did that? It is emerging development country consumption drop from 74.2% drop to 67.5% and continue to drop. The investments increased 25% to 30% to 31.85%. In a small world, everybody have to move response to the other people's move. The question is this 80% consumption is sustainable? Is this 20% investments is sustainable or will generate enough growth for advanced economy? Answer is maybe not. So there maybe go back. What level will be the equilibrium level is not all clear because it's the process. But the question is not here. The issue is, if advanced moving back, reduce their consumption, which we see a little bit of here, not very big, but start to change a little bit of that, which is a good thing I see. But what will happen on the emerging market? In roughly 20 years horizon, advanced economy increased 5% consumption, reduced 5% investments. Emerging market reduce 7% consumption and increase 7% investments. If the whole thing have to reverse, we'll see a big change in the global restructuring. Remember, the big part of this change ended up with the crisis in 2008. When it's a reverse, what will be the process? What will be the policy? We have more come to structural issues. The aging is a bigger issue. I mean, we see this is very much everybody familiar with it. I don't have to come to this. China's, the labor supply curve is drawn down. Japan and Europe and drawn down dramatically. I mean, everybody sees the labor supply issue, but it's more than that. Have a huge impact on the fiscal issues because you need to redefine your pension, your health care, your Medicare. It's a huge impact on consumption pattern change. It's a huge impact on the inflation rate change. And with geographic change, with demographic change, and every country needs to redefine their production function. I think there will be another big challenge for the countries in the world today as well. And income also is a big issue that we saw there. This is a nice chart. I borrowed this chart from Milan Novick. And the fund usually believe we have everything. We don't like to borrow tables from others, but I think this is very convincing. So this is a low-end income country where income increase dramatically. China, India, Bangladesh, Vietnam is all here. But you will see this upper middle class really drops. And this is 88 to 2008, 20 years. And then the upper middle class increase, this is 0.1%. Right? It's really. And it's cost everybody understand. But what is the implication for growth? Today, we have a very strong growth in US, which is great news, but we see big income inequality also happen in the United States. Is this the model? On the other hand, emerging market, low-income countries have a strong growth, but they also is the Gini coefficient deteriorates. Is that the model? So they put the change and ask we to think about how do we reconstruct our production. And this is, I borrow another chart on to show the productivity actually and increase and in the advanced economy almost unanimously and on the downside. The answer is if you go back to the solo model, if you don't have strong labor supplies incrementally, if you don't have a strong capital supplies, and your capital intensity increase, you need extra more capital to hire labor and to produce productivities. Your productivity will not grow strongly. Do we need the new different production function? You're not sure. How do you say you're not sure? We can talk about that. And so this is also very interesting. And also another interesting issue really come from, I think I should be very fast here. It's really interconnectivities. What we found the world linked to each other is really through, I call it cluster structures. So it is not a country linked to country, everybody go to New York. It is rather a small, we call it cluster. There's a gatekeeper lead this cluster to the big group, and the big group leads them to core. Because the cluster impact, interconnectivity increase dramatically. This is the case for European, this is the case for the machinery clusters. I'm not going to go through it. And we found the world is very much grouped themselves by three groups. It's advanced economy, it's a service, and financing, emerging market, supply chain, and energy group. And the consequence, we see strong co-movements. And we see co-movements in the equity market, currency market, bonds market, everybody experiences, particularly in the crisis periods. And we see co-movements in the equity market across different regions. You see in the Latin America and the East emerging Asia equity market co-movements roughly from 40 to 82%. And during crisis, co-movements increase. I mean, why is that? It's the interconnectivities, inflation, behavior change, and also a lot of the American become supply chains. And the global growth also showed a certain correlation. In the crisis, the growth, co-movements increased dramatically. Now it's lower, but still much higher than before. And this is generally all be the spillover. We did a US case where we found the red bar is the fiscal spillover from US, and the blue bar is the macro shock, the real shock. It was Canadian, Mexico, Saudi, and China will receive a lot of shock from US if US have both the fiscal and the real economic shocks. And more than that, it's not only the spillover, we found there's a spill back because emerging market become very big now. So advanced economy slow down, certainly will have a negative impact on the emerging market. There's a 1% growth shock after 4 quarters, roughly half percentage for the emerging market. But 1% shock from emerging market will have roughly a 1/4% shock back for the advanced economy as well. We're truly linked and live to each other. So then come to this end, if I go through the whole thing, we see the cyclical change trends, we see the financial sector movements, We see the limited policy space. We see structure change. So at the end of the day, policy response to this, I would say, is first issues, we need a growth enhancing supply side policies because we don't have very much policy space. So I would say structural reform is still the key. The product market competition enhance is very important. I learned great deal from European cases. And the labor market flexibility is a big issue for many countries, particularly in Europe as well. And increased service sector productivity is a universal issue for everyone. Pension reform is a part of that. We need a smart investments, which is not only infrastructure investments. It's really putting the knowledge economies and innovative SME. And the smart investments are really pushed for the advanced economy for the country in the frontier already, move beyond the frontier. And for the country within the frontier, push them, bring them to the frontier, right? I mean, we have to think that way. It's not only infrastructure per se. And we need the supply side supporting monetary and fiscal policy, which will support the supply side. Let me put it that way. It's not a separate the supply side policy and the demand side policy. I think it is very important. The whole idea is we need to focus and move more to the supply side, given the demand side is very limited. And we need to maintain the macro stability, and, which is very clear. I just list, I think I'm not going to repeat. And the global cooperation is really, once again, become key. On the facilitating globalization, trade capital flow, once again, enhancing global financial safety nets, the liquidity issues will, once again, with the market liquidity illusions, I think it's a big issues. Implementation global regulatory reform still is a big challenge. Put into the practice lateralism, I think it's also very important, is the global governance as well. So if I can put them together to summarize in 30 seconds, I would say after 7 years or 8 years, we'll see the growth is still moderate. Yes, we still have a growth. It's not too bad. We'll talk about before it seems, is it positive, is it optimistic, or is it pessimistic? I think the real thing is we do have a growth, and, but growth is moderate, and the fiscal sector rebounds strongly, and the risk really accumulating. With demand side of policy, structure issue emerges, and then we need to move to supply side policy. And then we need a very proactive actions. So the year 2015, we need a change. We need the leadership. It seemed to me, this is a changing world. The world is changing. So everybody have to adjust to this changing world. And who is loser, who is a winner, it's not all clear at all. But I know one thing is clear, depends on what policy action you take today. So we'll have to act, we'll have to breathe. It's a new world. Thank you very much.
Thank you so much, Min. I'm going to roll with punches. Oh, that worked. Does this work? I'm going to take a hint from the microphone that I'm not really supposed to talk and turn it over in 1 minute to our distinguished audience for on-the-record questions and comments, which Deputy Managing Director Zhu has kindly agreed to take. Just one point you raised in your speech among many. It was incredibly substantive and comprehensive. In German, we'd say it's a Gesamtkonzept, you know. You hinted at the tension of these historically unprecedented fiscal imbalances in the rich countries are close to unprecedented. And you pointed out that part of what makes it so strange is that the markets keep feeding this. We're all wrestling with variations of that story. Can you give us just 1 minute more or 2 minutes more on why you think that we have this juxtaposition of such low rates with such high debt, and that the rates don't seem to discriminate between the highest debtors and the lowest debtors at the moment.
That's a very good question. It's two things.
Can everybody hear him?
What?
Okay. Yeah, it's fine.
That's good. Thank you. The two things obviously link to each other. Yeah, on the debts and the rate side. The high debts always suppress the growth. Very, very important. And the weak growth make the reduce the debts ever difficult, right, as I indicated in few slides. The market did not distinguish very much at this time, exactly as I pointed out, because this is the globalization. And the one thing is, the market move with the short terms is not with the long terms. So whether it's looking for the short-term profitability and profit opportunities, or really the confidence invest on these issues, it's unsure, it's unclear. And globally, the sort of rates globalization is really move much faster than we thought. But meanwhile, it's the volatility all the time. So at the end of the day, it's not to look the rates to assess the quality of a fiscal position. It's rather the volatility to assess the quality of the fiscal position.
It's very, very interesting. So again, I will resist the urge. I'll open up the floor. We have a traveling mic and Jessica's hand up at the front. We have a standing mic at the back. As usual, if you wish to ask a question, please identify yourself and please pretend you're asking a question, not giving a speech. And as usual, I'll ask that my colleagues hold back for a moment and let some of our outside guests ask the first question. Someone volunteer here, please.
Thank you, Min. That was an incredibly comprehensive and thoughtful speech. I think for 100 questions, but let me start with one.
Who are you?
Sorry, Krishna Guha, Vice Chairman, Evercore ISI. So you you emphasize, of course, the weakness in investment globally. And I think an interesting question is whether that isn't endogenous to the weakness in demand, or whether there are some deeper structural causes for that weakness in investment, particularly in the developed economies. So I'd ask you just to sort of discuss a bit whether you think that this is ultimately, for the most part, simply a product of the weakness in demand. And associated with that, I'd just challenge a little bit your suggestion that we're close to out of policy ammunition. The SNB this week showed us that they think you can take interest rates much more negative than anyone has tried before. Balance sheet constraints are at least debatable. And the trade-off between short-run fiscal stimulus and long-run consolidation, these are complex issues. So interested in your thoughts on that.
Oh, thank you. Not for 100 questions, but your one question includes 10 parts already. And no, can you repeat your first issues? I'm sorry, you 10 parts confused me a little.
Is the weakness in investment?
Yeah. Are we
really as short on policy ammunition as you suggest?
I think it's two things. In the investment side, it's an endogenous, and it's not only demand, it's also from supply side. When you see the uncertainties, you see that the fiscal debt is way high, you will think about what is the future tax codes, what is the business environment, right? And you see the global competitiveness shifting and moving around. You don't know what is your production functions. And you will reconsider where and what to invest, right? And I think the machine disagree with me.
Technological regress.
So then, if you put in those things, you will see those things. And the business community is very careful to move the money forward. And also with the volatilities in the financial sector as well. So with all those things, put them together. And the other thing is the macro policy on demand side this time, compared with any crisis we had before, was not be able to create a big enough space to build a confidence for investment to move forward. I think that's the huge difference, because when we get into this crisis, our space for the fiscal space is already very limited, and it's very careful to move forward. As I said, we're in the model between the Japanese model and the UK model, So everyone is very carefully moving. You will not be able to move the credit at first place. The business community confidence never get as high as we observed before.
Okay, thank you. Next question. There's no volunteers? Please.
I thought I'll let you go first.
Oh, okay, well, thank you. Hi, this is Anna Yukonana from Reuters. I was wondering if you could speak a bit about central bank communication and cooperation. You mentioned that as one of the issues in general. And I guess this week's decision by the Swiss National Bank was a bit of a surprise to most other central banks. Do you think that that's a sign of things to come, where central banks are kind of going to act unilaterally based on what they view as the needs of their own country, or is that just a surprise this week and kind of one country on its own, just that issue? Thank you.
Yeah, that's a good point. The central bank communication function has become more and more important, than ever before, right? And there's two different communication. Communication among themselves, the central bank community, is very important, and also the communication to the market is also very important because, as I say, the market have structure issues and have liquidity issues, and the proper communication between the central bank to the market to ensure the market will respond in the way and the central bank sort of expected in the policy framework. I think is also important. We are working very hard in enhance the central bank community communication among themselves, and encourage the central bank do a better job of communication with the market as well. I would say the situation is really, in terms of transparency and monetary policy, you will see today compared with a few years ago, I would say it's improved quite a bit. And there's still room to work further. Yeah, I agree with you.
Before we continue, on this issue, we've already had a pretty lively internal discussion here at the Institute, as you might imagine. Just let me say that I'm one of several people who thinks on this score the Swiss National Bank is getting an unfair set of criticism, including from Madame Lagarde. That it's ridiculous when you're on a peg to pretend that you're going to spread around word of getting off a peg. We all know what happened when the Swiss National Bank announced the peg in the first place. That's part of the reason why pegs have generally been abjured in recent years, and we understand there's reasons the Swiss did it. More importantly, picking up on the thrust of Anna's question, I'm going to go out there and say central bank communication is overrated. It's sort of motherhood and apple pie right now, but it's secondary to getting the policy right. And if you pursue a foolish consistency in your policy for the sake of not warning people or not being seen as reversing yourself or whatever, you may end up doing yourself and others a lot of harm. I guess my final point, just for what it's worth, and we're going to be publishing later today, if we haven't already, a blog post by Ted Truman on this, which is not identical to my views by any means, but is similar, I think, on a lot. This idea of unilateral central bank action is also a little bizarre. If anything, you want to look at the Swiss National Bank right now doing as the People's Bank of China did back in the 90s during the Asian crisis, which is saying, okay, the rest of the world is having a real problem. We've got a large current account surplus. We can let our currency go up. And I don't view that may be unilateral in tactic, but it's actually far more constructive for the system than a lot of other well-communicated but entirely self-serving policies that are out there. So I personally find this a really bizarre set of criticisms people are making, unless they happen to be bond traders, in which case, who cares? Anyway, next question.
Thank you, Mr. Zhu. My name is Dong Huiyu with China Review News Agency. And you didn't touch a lot about China, but the world is focusing China right now. And many expect that in the next 2 years, if China did not promote the reform that is stated in the third plan, the Chinese economy might have a hard landing. So what's your view about that? And what is the key to address the so-called new normal of the slower Chinese economy? In other words, what is the key to unlock the potential of Chinese economic growth in the next 2 decades? Thank you.
Thank you.
Well, as I showed in one chart, first chart, Chinese economy has been slowed down, and from the peak, roughly 10.2%, so gradual slowdown. And we will see the Chinese growth will continue to slow down a little bit, but the slowdown for good reason, because China is doing huge work on terms of internal rebalancing. We see the first size evidence, which is very positive. So last year in China, actually, the consumption contributed to the GDP growth is bigger than the gross capital formation contributing to GDP growth. I think this is very positive. And last year, you will see the service sector in terms of total share of GDP is bigger than the industry sectors. So could you see the reforms start to show the impact, the consequences, changing the structure of the economy? But when you change the structure, when you do things, you reduce vulnerabilities, the growth will slow down. And so that's we say the growth will slow down, but it's for good reason. Yeah. And we encourage the Chinese government to continuously to push the reform agenda, and when don't have to maintain a very high, strong growth as well.
Great. Now my colleagues are free to raise their hands just like anybody else. And I'm assuming one of them will if nobody else does. Hint, hint. Okay. Please, Bill.
Bill Klein from the Institute. One of the things you didn't really touch on is where we should think the main economies are now in terms of their output gaps. Because if you think that there's a huge output gap, then you tend to think you ought to go slow on the fiscal correction, on the increasing the taxes, reducing the spending. If you think there's no gap, then you are inclined more to try to bring those debt ratios down. So I wonder if you could say something about where you see the right diagnosis on that. And a related question is, on your concern about the debt, the really key question is whether the increase in the average interest rate that's going to be experienced will exceed the increase in the growth rate as we get back to more normal growth. Implicitly, you seem to be worried that there will be a much larger surge in the interest rate than there will be in the growth rate. And I wonder if you could say why that is your view. Because as you pointed out, the striking irony is that despite these much higher debt levels, the interest burden has not changed. So to recap, where are we in the Keynesian recovery, and how does that affect our view toward the right fiscal policy, A, and B? What's going to be the relationship of the resurgence in growth to the resurgence in the government interest rate?
No, Bill, it's a great question. And many countries in the world today have output gap, except US. US grows strongly. We expect to see US continue to grow very strongly this year, so way over this potential. But for many other countries, even emerging market as well. So there's a reason I emphasize move on to the supply side policy on the structural reform issues to unlock the growth potential. I think we need to shift or emphasize for the policy issues and looking for the long-term productivity, looking for the human capital formations, looking for the knowledge economy formations, and move into the new area. So that's the way to push. Because in the past 7-8 years, when we use a lot of space for the aggregate demand policies, we try to push the whole things, but not very much happened in the supply side. The cross-border FDI drop is a really clear indication for the weak merger and acquisition for the wake of a global industrial structure change and the productivity change as well. So I think that means there's output gap is clearly, but we need to shift the policy focus to unlock this way, not a classical way. On interest and the growth, it would be very good to have the growth is stronger, that the interest and the growth parallel go further and further. I think that this is a very ideal world. We see those things happen in the past, so that we'll be able to maintain stability on the fiscal situation. But meanwhile, the interest rates today is a more sensitive subject to the market. It's not, if you read the market today, actually, the market median-term interest forecast is lower than Fed forecasting, much lower, right? So that's good news. Right? And even if you're looking for the long-term rates, it's much, much lower. If we can continue to keep it that way, I think we'll probably solve your concern, the growth and interest rates. We'll be able to maintain fiscal stability, which is good, because we're very much concerned the fiscal risk is materializing now, and given the weak growth, given the low inflation rates, and given still general negative on the cyclical adjusted the primary balance. But market rate can be very volatile. Now it can change quickly. You see how much oil shock changed the market rates, change the spreads, right? Change the bonds yield, change interest rates across all different countries. You see all this change. So this is actually a key issue. How do we the manager? That's interesting issues, and from not only the central bank perspectives, but also from market perspective. I use the word manager, which may not be a proper word. Yeah, not a proper word. So let me point out that. But how do we see this process? It will be very important. Yeah.
Thank you. Ted?
Thank you. Ted Truman from the Peterson Institute. I'm tempted to expand on central bank communication, but I think I've got enough of an advertisement for the afternoon. I was struck by your implicit, I don't think you said it in quite this way, saying in a way the financial sector is disconnected from the real sector, and I'm worried, or we're worried about whether we actually have too much activity over there in this shadow banking sector and so forth and so on. An alternative view is that's exactly what we want. Right? The name of the game for monetary policy over the last several years has been push down the interest rates, to push out, get people into non-conventional financial arrangements, right? Don't take the burden off the banks and put it into the capital markets in one form or another, which includes hedge funds and dedicated funds of one sort or another, right? Where they're prepared to take risk. So the question is whether are you right that this is bad news rather than good news? Maybe it's success. If we have actually non-bank financial intermediation rising relative to traditional bank financial intermediation. Maybe it actually is one of the reasons why the U.S. economy is doing marginally better than the European economy, for example. And I wonder how you would react to that kind of criticism.
No, that's a fair point, Ted, and it's a good question. You would say it's a good issue until we get into crisis, right? Because you may say we want to have that situation, right? It's sort of a design consequence or result. You can see that, but until we get into the crisis, and it's really hard to say ex ante. But the key issues, say we observe the risk as there, as I said, the credit intermediation moving away from traditional banking sector to non-bank sector. It's not a small size. It's not a small size. It's $1 trillion business into these asset management companies. And the transparency is not all clear there, right? And we see the concentrations. I mean, it's concentrations in these countries, particularly in the emerging market, right? The 5 major asset management companies hold quite a big chunk of the sovereign and particularly copper bonds in the emerging market, and way, way high. If one of these big guys move, the market will shake, right? And we see the liquidity issues, you know, the size the market need to clean, and also the dealers' inventory of issues. We see there's an illusion of the market liquidity, which is against normally we call the monetary liquidity from the central bank point of view. So we observe those risk facts is piling up. So we're very careful. We see those things support, help for the growth, and particularly for the consumption side, we'll see that things happen that way. But it's always a balance to, yeah, I think this is a very tricky issue. I have to agree with you. And so we're very careful how can we, when shall we make a call on those issues.
Yeah. Min, you've been fantastic. You've covered the waterfront almost on an interstellar scale, and I'm very grateful.
Thank you.
If I could, just one last question.
Okay.
I mean, we're all going to be thinking about the things you said for a while, but about 2/3 of the way through your presentation, you put up your famous sort of emerging market growth, you know, with the squiggle, 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 and then the last 10, 15 years we're going this way.
Yeah.
Oh boy, I'm now being heard. So let me channel Robert Lucas of all people. Let me channel Robert Lucas for a moment. If the billions of people in emerging markets in China, and not just China, have seen such great progress, and even in the inequality chart, it's come with 0 to positive growth in the rich country. It has not come at the expense of the rich countries. And you, in that chart, are forecasting that growth to continue.
Oh.
What is there to worry about? I mean, isn't in a sense everything else second order small compared to that?
I don't forecast it will grow forever. Otherwise, there's no need for you and me sitting here.
Right.
Yeah, we should go to beach, right? Like in such a cold winter Washington days. I mean, no, I don't think a forecast will grow forever. It's just suppose they had a beautiful period for the past 10 years, but all the history say it's a bumping road. But there's a point. The point is if you see all the adjustments in the past, it's very due to the external shocks. Mm-hmm. The emerging market will continue to adjust to the external shocks, but now they need to more adjust to the internal issues because they become big. And you cannot depend on the external demand. External demand is not aggregate demand. It's the external demand that defines your economic structure. So it makes things much easier for emerging market to move forward. You think of the Asia financial crisis. Why has a quick rebound? You fix financial sector, which is rather easy, you can fast, you change the whole thing. But then all the external demand drive your structure change.
Right.
You follow. It's gone. Because you have to move your demand to internal. So you have to form your structural reform policy from inside the red, from outside, which is a very different game. So in that sense, when the charges say the emerging market have to change their growth model, but the charts also say, because emerging market is very big now, their growth becomes the public goods of the whole world. So world need to pay more attention, should work together and to facilitate this transition process.
Fantastic. Perfect note to end on. Thank you all for joining us very much. Thanks to Minzu.